Well, hello everyone. If you, those of you still coming in, get your seats. I am Adam Zorroski. I'm the Deputy Secretary for Energy and Finance for Governor Cuomo here in New York. And on behalf of the Governor, I wanted to welcome you to this interesting and important discussion. At the outset, let me just do some thank yous. First off, thank you to the Sabin Center and the Earth Institute here at Columbia University, and to Mike Gerard, who's doing double actual volunteer work, not just helping us here get some insights on this first panel, but also with his hospitality and the hospitality of his colleagues. So we and the Governor are very grateful for that, and also grateful, of course, for Columbia's leadership, thought leadership, action in this space. Also, of course, as an initial matter, we'd like to thank our panelists and I thank our audience members. We are very committed and very excited to this, about these projects and about this work, and it's great to have such engagement. Let me just spend a minute, if I can, talking a little bit about here in New York and under Governor Cuomo's leadership, what we're doing and why we think this is an important conversation, and then turn it over to our terrific first panel. Governor Cuomo is committed to being a leader on climate and fighting climate change, but not just combating its risks, but also taking advantage of the opportunities that the transition is going to afford. And so some examples of that are, we have a state mandate that 50% of our electricity will come from renewable sources by 2030. We have a 80 by 50 carbon greenhouse gas reduction target in the state. We have the nation's largest green bank, and you'll hear from them later on the second panel. We have Governor Cuomo is one of the founders of the U.S. Climate Alliance, which occurred the same day that President Trump announced we were going to withdraw from the Paris Accord. Now we have 15 states and Puerto Rico representing over 40% of the GDP of this country who've said we're still in, and we're working together. And interestingly, it's not just working together on Paris goals. We have found in that vehicle tremendous opportunities to say, hey, what about this, what about that? Green Bank being a good example. So it's presented real opportunities. But we're not done. And you know, the Governor, notwithstanding all the terrific work we've been doing at the state, is mindful, that, as someone once put it, that it takes a village to do this kind of thing. And that means also private capital. It means public capital, it means investment dollars, it means engagement from academic, from thought leadership, NGOs, and everywhere in between. And so that is why this work is so important. It's also why, as some of you probably know, during his State of the State address this year, the Governor announced a partnership with the Office of the State Comptroller, which oversees the New York State Common Fund, $210 billion roughly of investments. And that partnership has been terrific. We are excited to work with the Comptroller's Office. I've been involved in that personally. We've announced the first ever National Decarbonisation Advisory Panel. That first meeting will be taking place a week or so. And they're really ready to roll up their sleeves and do the hard work of figuring out how we transition meaningfully, thoughtfully to the new energy economy. Because that's what this is all about. And that's why, of course, we're so pleased to be here today. So you'll be hearing a little later, in addition to our panelists, I'll call him a surprise guest, but perhaps not so much, from John Rhodes, who's the chair of the Public Service Commission here in New York, who oversees a lot of this work. He's going to be speaking a little bit more about the specifics of what we are doing here in New York. But just as an outset, thank you for being here. Thank you to our panelists. Thank you to Columbia. And it's my pleasure to introduce the moderator of our first panel, who made me promise I would not go through the slideshow of her life up here on the board before I told you about her. So instead, I will just keep it to the following, which is that Lisa Sachs is the director of Columbia's Center on Sustainable Investment. She joined that center in 2008, became associate director in 2009, and apropos of her talents, became the full-on director in 2012. She's also overseen advisory work in as far-flung places as Mozambique and Tanzania, and she's a member of the UN Sustainability Development Solutions Network, and a mother of three. And she had me beat because I have 3 kids under 8. She has 3 kids under 6 and is still doing this work. So I'm jealous of that as well. So with that, I'll turn it over to Lisa and our terrific first panel. But again, thank you all for being here. And we in New York, I can say it with absolute conviction, are committed to this work and welcome all your voices as we work through the various ways to make this a reality, because it's too important. Thank you. Lisa.
Yes. So thank you so much for that introduction. The 3 under 6 is only one of the smaller reasons that I'm really delighted to be here and not home. But the main reason is this incredible panel that I'm really honored to have the pleasure to, honored to be able to moderate. We all know the enormity of the challenge that climate change presents. What's exciting to me about these incredible panelists is that everyone on this panel has embraced the challenge and is actually practically working on approaches and thinking creatively about political, financial, and legal dynamics that come to bear on the task of decarbonizing our society. In preparing for this panel, it was useful to reflect on how new the concept of using finance to build political power and promote responsible corporate conduct on climate change really is. The independent financial think tank Carbon Tracker only introduced the world to the concept of a carbon bubble in 2011. Henrik Jeppesen now works to spread Carbon Tracker's message across financial institutions in North America, encouraging them to internalize the risk that decarbonization poses to markets. A year later, in late 2012, Jamie Henn co-founded 350.org, where he now serves as Strategy and Communications Director. 350.org, of course, launched the fossil fuel divestment movement. Both of these efforts have thrived thanks to the support from the Wallace Global Fund, which funds social movements for progressive change. We're joined today by Ellen Dorsey, the Wallace Global Fund's executive director. Ellen also funds the Divest Invest Philanthropy, a collection of 150 funds that are committed to aligning investment with climate change and accelerate the clean energy transition. And then, of course, there's the critical question of how the legal and policy framework shapes this political and financial realignment of incentives, and how the laws and policy themselves need to change to enable the transition. And few have thought or written more about the legal and policy dimension of decarbonization than Michael Gerard, the faculty director of the Sabin Center for Climate Change Law here at Columbia Law School. The results of these efforts in this very short time have been remarkable, as I'm sure our panelists will describe, even if the challenges ahead are equally as remarkable. So with that brief stock taking, I'm excited to let the panelists take over. In addition to the impressive complementarity of the work of our panelists, I also want to highlight their exceptional diversity of experiences, which we'll try to bring out in this discussion. And as much as possible, as we've discussed with them, I'd like to probe beyond a description of the challenges and strategies and try to engage with unexpected learnings from the past several years, the challenges or successes, and importantly, where we go from here. And then after we hear from the panelists, we'll hopefully have time to open it up for a little bit of discussion with all of you. I'm going to join a seat next to Jamie, but as I do, I wanted to see if Michael could start us off by giving us a brief sense of the magnitude of the decarbonization challenge, and in particular the implications for companies, both fossil fuel companies, but also other companies that are going to be part of the new energy solutions.
Thanks very much, Lisa. So the Paris Climate Agreement, as you all know, said that the maximum tolerable increase in global average temperatures was well below 2 degrees centigrade, 3.6 degrees Fahrenheit, above pre-industrial conditions, and that we should try to keep it down to 1.5 degrees. In order to achieve that, the Paris Agreement said that by the second half of the century there should be, quote, a balance between anthropogenic emissions by sources and removals by sinks of greenhouse gases, close quote. The sinks are primarily the forests and the oceans, but they don't remove nearly as much. And so in order to achieve that objective, it's necessary to phase out the great bulk of the use of fossil fuels. And very little fossil fuel use can remain consistent with this objective, at least unless the power plants that burn fossil fuels for electricity are all equipped with carbon capture and sequestration, which only 2 in the world are. It also raises the issue of the carbon budget, a concept that Henrik and his group have done a great deal to study and promote. The basic idea, what's the total amount of fossil fuels that we can still burn and greenhouse gases that we can still emit into the atmosphere, but still be within our temperature goals. And most of the estimates, they vary, but most of them say we need to be completely out of, or almost completely out of fossil fuels by the middle or latter part of the century, because we're going to be using up our whole carbon budget at the current rate that we are exhausting it. So this poses a great danger to the fossil fuel companies and to the electric utilities and motor vehicle and engine manufacturers and others who make the equipment that burns the fossil fuels, so that if society really does get serious about climate change, the fossil fuel companies that have not thoroughly diversified away from fossil are going to be in very bad shape. All this means that society needs to undertake a massive program of decarbonization. And this has three essential pillars. The first pillar is energy efficiency. The second pillar is switching to entirely clean energy, meaning renewables and nuclear. And the third is electrifying what is now on fossil fuels, led by motor vehicles and by space heating and cooling and water heating and so forth. This would about double the amount of electricity that we need, but if the electricity comes from a clean grid, we're in good shape. It will be necessary to build dozens of large offshore wind and onshore wind and utility-scale solar facilities each year out to at least the middle of the century, plus transmission lines and storage and rooftop solar and charging stations and all manner of other equipment to go along with this decarbonization. There are several estimates of how much this energy transition will cost. Some of them are on the order of $200 or $300 billion a year, every year for decades. This is a tremendous opportunity for a wide variety of businesses. Clean energy needs to be and probably is a boom business for decades to come. Already the Bureau of Labor Statistics has projected that the two fastest growing occupational categories in the United States are solar installers and wind turbine technicians. If we don't do this, if we don't have a massive and fairly prompt transition away from fossil fuels and toward clean energy sources and electrification and efficiency, we will blow past the Paris temperature goals and be faced with rapidly rising seas and scorched cities and parched farms and tens or hundreds of millions of climate refugees and all sorts of other negative impacts. And this obviously would all have devastating economic consequences as well as human consequences. Even under the best of scenarios, even if we do manage to keep within 2 degrees, there will still be a lot of negative effects from climate change, requiring major shifts in key industries such as real estate and agriculture and insurance, as well as in public infrastructure providers. We cannot have a world without either deep decarbonization or terrible climate impacts. We will have one or the other, or possibly both. Yet, if you read the securities disclosures of many energy companies, we'll have neither. Investors who believe that, who believe what they read in these reports, that we will get by with neither deep decarbonization nor significant negative climate impacts, are being misled. At least unless they are investing solely in the short term, they need to be thinking more broadly about that. So climate change and the fight against it pose great risks to some companies and great opportunities for others. Rational investors need to take all of this into account, and investors who care not only about the returns on their investments, but also are thinking more broadly, need to do a lot more to get us onto the right paths. Thank you.
Great. Thanks so much, Michael. Always very sobering to hear you speak, but it's nice to work in the same building. You know how much you're doing to change the reality. Focusing first on the side of phasing out fossil fuels in decarbonization, Henrik, I was hoping you could speak a bit about what that implies in terms of risk for investors who remain invested in carbon-intensive industries, and how that concept of risk has evolved, and if you think it should still evolve, what more we need to do to better understand risk.
Yeah, thank you, and also thank you for the invitation to come and speak here. Carbon Tracker was, as been mentioned a couple of times here, we were launched back in 2010-11. We are a Financial think tank, independent of banks or governments. We are philanthropic funded, headquartered in London. And all the employees are really either City of London or Wall Street professionals, either from the financial services side or from the legal side. And we do financial research in order to better understand the transition to a low-carbon economy for investors. Going back to 2011, when we came out with our first report, it's really based on the basic idea that we can emit it all. And it was taken up by our founder, he was a fund manager in London, Mark Campanale, who really came up with the idea that, well, if all the climate scientists are telling us that there's only a limited amount of carbon we can emit, as Mr. Gerard just said, that is a constraint on the demand for fossil fuel. That's not so good for the people who are supplying these fossil fuels out in the future. So he was basically looking at these different carbon budget scenarios out there or calculations, and then also looked at what is embedded in the balance sheets and also in the future prospect for the oil, gas, and coal companies, meaning they are the people who are supplying with the emissions in the future. And here he found that basically there is a 5-6 times larger potential supply of emissions than we are allowed to burn. That led to the inspiration for the Bill McKibben's article, The Terrifying Math, etc., and 350 and all these other things. But if you turn that around, that also basically means that it's around 20% of the fossil fuel reserves and resources that we can go ahead and burn. And that's a bit of a problem if you are invested in this sector, because all of these companies, if you look at this from a pure financial point of view, and maybe I should say that in the beginning. So I joined Carbon Tracker last year. Before that, I worked basically 20 years across both buy and sell side as an investor and a banker and as an analyst, covering energy companies, primarily focusing in the Northern European area. You might hear that I'm not from around here, but I'm originally from Denmark, but worked a lot in the Northern European area. And all of this here is a big problem if you are invested in this in the fossil fuel sector, because if you take a very basic valuation of fossil fuel companies are really based on what are the reserves these companies have, then you can put some multiple on them, and then all of this assumes that there will be a replacement of these reserves. But if we are right, and also with the Paris Agreement and all these other initiatives happening, these replacement of reserves might not happen. That's not so good if you look at the overall valuation of these companies. The other thing that comes into this is a little bit inspired by Mark Carney, the Bank of England governor, who back in 2015 also made a speech, and he actually made a little bit of a follow-up speech last week in Amsterdam. And he is also highlighting 3 areas of risk that we are also very focused on. And one, of course, is very obviously the physical risk. We have seen what happened in Puerto Rico, in Houston, in Miami, etc. Now they had a big power outage yesterday in Puerto Rico. And these are some of the physical impacts. Loss of trade, people can't get around, and there's a lot of property damage. That's a risk. That's not only for the fossil fuel companies, but this is for investors overall. This can have a big impact. Then there's a liability risk. If your power is out, or if your building has been blown away, then you need to have that replaced, or you can go and seek damages, as some of the now states and cities around the world have started to do against some of the oil and gas companies. That's of course also a big risk. And then the last, very big risk is the transition risk, and that is what is happening if you are a utility company, if you are oil and gas company, and you're investing in deep water project, 30-40 year time horizon, which you expect them to produce, create cash flow you can use for reinvesting, repaying out dividends. If this is not happening and materializing out in the future, that can lead to what Carbon Tracker originally was I think we got our claim to fame for, was coined the term stranded assets. So there's a lot of these potentially producing fossil fuel assets that can become stranded. They can't generate the return that they should generate in order for the investment to pay off. So these are some of the, I think, the very big risks that you have to include. And then, of course, you should also think about what are the other risks. If you look at the automakers and the oil companies, both of them have predictions for the uptake of electric vehicles. And we did a little quick survey. It was not really super scientific, but we're really seeing what has the disclosure been from the automakers and the oil companies. And automakers expected that they will sell around 20 million, 25 million electric vehicles by 2020. The oil and gas companies also expected around 20, 25 million electric vehicles on the road, but by 2030. I don't know where the reality is, but they cannot both be right. And if there's more electric vehicles, that means there will be less demand for fuel, for gas to fuel the cars. So these are some of the many risks that you have to be aware of. So this is what we as Carbon Track are really focused on, trying to measure and calculate better.
Great. Thanks so much, Henrik. Jamie, as Henrik said, this led directly to some of the creation and the work of 350 and pushing both for the moral and the financial imperative for divestment. I was wondering if you can speak to divestment, but also I'm interested in what you've learned, what you've learned over the past 6 years. Any unexpected learnings? Any great successes?
Sure. Well, it's good to be here. Thanks for having me. And yeah, it's a good order because when this article came out from Carbon Tracker, we were sitting at 350 and thinking about ways that we could begin to continue to expand this movement to try and systematically take on the fossil fuel industry. And when this report dropped, I think the significance of it, it was really felt that this was an explosive study. And so one of our first jobs was trying to figure out how do we get this out of just the realm of financial discussions and really into the mainstream media. And thankfully, on our team is the writer Bill McKibben, and who has a good relationship with Rolling Stone magazine. So when he wrote that article, the Global Warming's Terrifying New Math, it had Justin Bieber on the cover. So we have Bieber to thank in part for helping kind of popularize the logic that led to the divestment movement. So as Lisa said, I'll give sort of a brief run through of where we've come from and some of the things we've learned along the way. Divestment really started actually before the report came out back in around 2010 when some students at Swarthmore College were looking at ways that they could help out some of the fights against mountaintop removal coal mining in Appalachia. They started really looking at the fact that Swarthmore had investments in companies that were involved in mountaintop removal. When we got involved in 2012, our role was to really try and expand that movement from just a handful of college campuses to every university in the country, then around the world, as well as any private institution that had investments and should be investing along the lines of some sort of social mission. I think that includes our cities, our states, our public institutions as well. Since that small handful of colleges that kicked this off, Ellen can correct me because our number keeps increasing by the day, but sort of by last count, we were at over 850 institutions around the world, representing now more than $6 trillion in capital, who have made some form of divestment commitment. This makes this the largest divestment campaign in terms of the number of institutions and capital, really of all time. And again, it's taking incredible inspiration from the ones that have come before it, the fight against apartheid, pushes against tobacco, pushes against private prisons that have happened here at Columbia as well. The campaign's had incredible success, I mean, far beyond what we ever could have expected in terms of the number of institutions that have taken part, but also I think even more importantly, the ripples that throwing this big rock into the financial sector has created. When we took on the divestment campaign, we tried to be very clear that our goal wasn't to bankrupt the fossil fuel industry. We understood that when Columbia sells its stocks in a coal company, someone else is likely to buy those. So while divestment wasn't a direct financial strategy, it did have a lot of financial impacts on the conversation that's being had in the sector, as well as political impacts on the social license of these companies. As Lisa said, this is a political movement as much as it is a financial one. By getting public institutions that we look to be the moral compasses of our society to step forward and say that these businesses no longer fit within the social norm, that their business plans are incompatible with the goals of things like the Paris Agreement, it allows the political sector to begin to move and begin to talk about the need to regulate or take on or challenge the supremacy of the fossil fuel industry. I think we are seeing that happen despite what is happening in D.C. right now. We saw the Obama administration over the years of this campaign come out much more strongly against fossil fuel development, going from an all-of-the-above strategy that you might have remembered back in 2008 to really taking on fossil fuel development in public lands towards the end of his term. And just as importantly, we've really seen cities and states begin to step up. This last December was a big step forward for the divestment fight when the state of New York and Governor Cuomo came out and said that they were going to divest the state from fossil fuels. That announcement was paired with an announcement here in New York by Mayor de Blasio and Scott Stringer, the comptroller, who were really able to move that forward. And now we're waiting for the state and the state comptroller, Tom DiNapoli, to take those steps as well. It's incredibly... The shoe drops. I guess Comptroller DiNapoli is listening, perhaps. It's an incredibly important moment for institutions to keep stepping forward. And New York is an iconic actor in this fight as the third largest state pension system in the country. It'd be incredibly important for it to make this step. But it is worth noting that it's very much not alone. Major insurance companies, AXA, StoreBrand, and others have said that they'll be no longer providing insurance for fossil fuel companies and moving forward divestment. Even the World Bank recently announced that it would no longer be financing upstream oil and gas development. We have just this morning or yesterday, HSBC making an announcement about ending a lot of its coal finance. This sector is truly beginning to move, and at this point, it's no longer a case of being the first actor, but potentially being left behind, holding the cards when everybody else has been moving out of these places. I'll end by just saying that Columbia as well has a responsibility and opportunity here. Columbia early on announced that it was divesting from coal, which was a smart move because if you didn't divest from coal, coal would divest for you just by losing its value. So good move dropping those stocks. But I know that students here are continuing to push for more transparency from Columbia's endowment and from its asset managers and trying to have more of a public conversation about what this university could do to continue to lead in really addressing these crises as well. So it's been amazing for me to watch this campaign grow over the last few years, see the different ripples that it's had in the political financial space, and the conversation that hopefully it continues to open up about the direction that we need our economy to be moving in, and also the responsibility that our institutions, our cities, our states have to take action, especially with the lack of action that's happening in DC at the moment.
Great, thanks so much, Jamie. Jamie set us up well with recognizing that we're in one of the large institutions that has resisted full divestment, and so as there have been a growing number of divestments, there are still some holdouts, and at least a couple of the critiques or the concerns that we've heard, including from our own institution, is first of all that divesting from fossil fuels will have a cut on profitability and that that's against the fiduciary responsibilities of the institution. And at least one other is that some of these institutions say if we divest, we leave the table, and we can be more engaged if we stay at the table as an investor. So I'm wondering if you can speak to those and any other concerns you've heard about the divestment movement.
If I come up the mic. So thank you for having me here. So I'm the head of a foundation. And a foundation has both investments, and then we make grants to nonprofits based upon usually 5% of our assets or more. We do more than most foundations. So the returns from the investments fuel the grants. And our foundation is a pretty typical foundation, except that we began our journey to overhaul our investments in 2009. Today, we're 100% mission aligned. We have a whole strategy, an ESG strategy of our portfolio to be consistent with our values in our grants so that our investments and grants are consistent. We're 100% fossil fuel free. We have been since early 2012. It only took a couple years to do it. We're 16% invested in climate solutions, renewables, energy efficiency, energy access, some clean tech. We track the carbon footprint of our portfolio. It's 12% that of a standard portfolio. But most importantly, we consistently outperform our financial benchmarks and bring the money home. In fact, we did so well last year with a pretty standard equity bond mix that our returns were 22% last year. So much higher than what we anticipated that we poured all of it back into grants for this year, doubling our grant budget. So I think the reason why I'm telling you this story is that one of the arguments, of course, is that you're going to lose money if you do this. And it's just not our experience, nor is it the experience of the 170 foundations that we've organized that have committed to divest from all fossil fuels, not just coal, and invest at least 5% of their portfolio into climate solutions. And that has been the experience of many of those foundations that range in size from trillions in, not trillions, billions in assets. That was a Dr. Evil moment. Billions in assets to, hundreds of millions in assets. We began this process because for mission consistency. In fact, we felt as a not-for-profit that received charitable tax status to serve the public good, we actually have a fiduciary duty to ensure that our investments aren't undercutting our mission in really powerful ways. We thought it was not okay to be invested in companies that were driving the climate problem, spending tens of millions of dollars in denying the science, tens of millions more in paying off lobbying is the correct word, to prevent any kind of action on climate change. And we were asking our grantees to clean up the problem with 5% of our assets. That inconsistency didn't work for us. And of course, with the carbon tracker analysis and the advocacy of 350.org, the movement began to explode around this. And in full disclosure, we've been funding it, including 350 and Carbon Tracker, and also the faith groups and the cities and the activists all around the world now that have taken this campaign now into a full-blown global social movement. So the financial argument, the financial imperative, what has made this movement explode is that the ethical and the financial are aligned. And the financial imperative is both the risk, as laid out by Carbon Tracker, the stranded asset risks, but it's also right now. The returns from the fossil fuel sectors are terrible. I mean, frankly, we got out of oil before oil tanked. We were out of coal before coal tanked. And it's been the worst, energy's been the worst performing sector for the last 5 years, generating returns at the level of treasuries. So with an energy transition underway, which how fast that transition occurs will determine how many tens of millions of lives are lost. So this is not a trivial question about our role in speeding that transition. But with the energy transition underway, those that are invested in the solutions now are already beginning to see the positive returns and are poised to capture the upside. And so smart investors are looking at how the energy system is changing and betting on the future. So not only do the financial risks and returns argue against the argument that fiduciaries should not divest, I would say they argue for a fiduciary duty to divest. The growing risk to staying invested in fossil fuels, coupled with the mounting legal claims against the fossil fuel industry for damages, a la think tobacco, think asbestos, they are further deepening the risk to staying in fossil fuels. And fiduciaries now have been warned. They themselves may ultimately be held liable if they put their investors, and in the case of pension funds, their workers' futures at risk or their capital at risk. So I think the fiduciary argument is just patently weak. You can deliver the returns, and you are limiting your risk. Now, on the issue of engagement, I'm not agnostic about this issue. I think that the arguments for engagement with the largest of fossil fuel companies as a reason to stay invested in fossil fuels is just wrong-headed. There's been decades of efforts to engage the largest fossil fuel companies on climate change, and they have produced relatively next to nothing. And the most recent efforts to push the companies to disclose climate risks are also not producing the results, and frankly are not fit for purpose for a 1.5 or 2 degrees warming world. Engagement to disclose is a slow walk. It'll stave off the divestment pressure, and the goals of disclosure are not consistent with the pressure of the science, i.e. the strategy is not consistent, not commensurate with the scale and urgency of the problem. It's too slow. We need to bend the arc of emissions now. And I would also argue that the strategies for engagement around disclosure are not fit for purpose. That is, that we need the companies to tender their 2 degrees or 1.5 degree business plans now, with clear benchmarks along the way, with no new fossil fuel capex by the end of 2019, a clear plan for managed decline in production, and of course, like every other business, reducing their overall greenhouse gas footprint to 0 by 2050. And I would also argue that any strategy to engage should also be calling on the industry not to lobby against action on climate change, which they're still doing. Increasingly, the industry is pushing to restrict any shareholder resolutions that tackle their core business operations, and are pushing to restrict those who can engage in the shareholder advocacy. We could talk a little bit about that more if you want to, if you find that interesting. But I think what we're already seeing is that tool may be threatened itself. And so if we invest only in the tool of engagement, we may find that it's stripped away. I actually think that engagement is fiddling while Rome burns down your pensioners' futures, and that the data is pretty clear. The fossil fuels are delivering terrible returns now. They will be a greater risk if we're Paris compliant. And with the rapidly escalating legal actions, including here in New York City, Boulder last week, 3 California cities, London and Paris are bringing forward legal actions, that the impact on the investors could actually be catastrophic financially. So taken together, fiduciaries are on notice. They could be held liable as well. Don't hang on to a failed engagement strategy. Divest now, protect your assets, invest in the solution, and if you really want to engage, do it with a few shares, because you have the ability to do that. You can buy a few $1,000s worth of shares. You don't need millions in shares to engage. So I think it's a very weak argument.
Great, thank you, and definitely have more to talk about on that. But I think whether it's from engagement and or from divestment, we have seen some, as you aptly said, tricklingly slow and pitiful disclosures from the companies, but they're coming. The ones that have come in the past couple of months from Shell and Exxon have been way off the mark of where we need to be. And that's not helped by the fact that actually some of the public scenarios from the IEA and others are also unrealistic in their scenarios. So I was wondering, Michael, if you can help to frame that, how we should be looking at the scenarios coming from the companies, how we should understand them, and also the broader scenarios against which they are, or could be or should be benchmarked.
So all of the IPCC scenarios for keeping within 2 degrees, rely very heavily on net negative emissions, which they primarily allocate to BECCS, bioenergy with carbon capture and sequestration, technology that hasn't really been commercialized, and if it were, under the current calculations, would require an absolutely jaw-dropping amount of land. Some calculations say about the equivalent of the land area of India, plus massive amounts of water. So it is very important to try to develop different and more effective negative emissions technologies, but we can't count on them as the IPCC scenarios do. The International Energy Agency has a scenario that is designed to bring us to 2 degrees that relies very heavily on renewables and efficiency, as it must, but it's not very geographically granular. The most specific set of scenarios that I'm aware of is from the Deep Decarbonisation Pathways Project that has come up with scenarios for about 15 countries in a lot of detail. Our center at Columbia is nearing completion of a book called Legal Pathways to Deep Decarbonization in the United States that looks at what needs to be done. But their basic scenario assumes a great deal of carbon capture and sequestration and a great deal of added nuclear. I don't think that either of those are realistic. So they do have an alternative, which they call the high renewables scenario, which involves an even larger number of major renewable facilities than the large number in their basic one. The oil company scenarios don't go anywhere close to that. The oil company scenarios that we've seen, they're what they are calling 2 degree scenarios, continue for the most part. There's some variation among them, but for the most part they are assuming a continued heavy reliance on fossil fuels. They They assume a lot of carbon capture and sequestration. They don't get us anywhere near to the deep decarbonization that we need. The only way we can realistically get there is construction of renewables and associated transmission and storage and so forth at almost a World War II scale of mobilization, just a massive amount of construction, which has very important business implications, big upside for some companies, big downside for other companies, but that's the kind of scenario that we really need to be looking at.
Henrik, we were talking about this before, but that investors looking at these scenarios don't necessarily know what they're looking at or how to evaluate them to properly understand their risk and to make informed decisions about what to do. So what, as the generator of tools for investors, what tools could be, or how can you support, or how can we support, what are the role of stakeholders in helping investors understand and better analyze these scenarios to make more informed decisions?
Yeah, thanks. There's this old saying that you can't manage what you don't measure. And well, first of all, scenario analysis is not new. I think that has been used for thousands of years. I think even Sun Tzu used it in his Art of War 3,000 years ago about how to run different scenarios and so on. I think maybe it's a new thing when we look at climate-related issues, but it's not a new thing in finance as such. It's maybe just a different audience of people who are primarily using it. At least that our view of all of this here, we use IEA's scenarios not because they're the best thing out there. They're probably, as I think we characterize it, as the least worst. But they at least give us a couple of things that we use as financial analysts to try and map out and give some quantitative numbers and measures to try and have to get an idea about who is more exposed and how. A lot of this here is really, they provide us with at least a pathway, 50% probability of reaching the 2 degrees. Well, we know there is a constraint on how much carbon can be emitted, so it cannot really be more than that we get from these scenarios. So if you want somewhere lower, it basically just will take and reduce everything from the scenario that we are looking at. It also gives us at least some details and some pathway when we look at different fuel types, gas, coal, and oil, which is also important to try and map this out. Because I think in all scenarios, I think it would be great if we could stop using definitely coal today. That would be the earlier we can cut that away, the better. But oil and gas is probably going to be here for a time to go, and we also need to go out and extract and find new resources in this area, unless we will have a very, very big disruption in the economy. And we also need oil and gas in order to produce some of the other renewable sources and so on. So we cannot all get away from some of these areas. But scenario analysis can really give us, it's a way of structure thinking about what is the likely outlook and pathway going forward. I think IEA's, the executive director, Birol, I think he was here yesterday at the Global Energy Policy Summit, I think it was called. And I think he was saying, I'm not saying I'm agreeing with him, but at least he said, I think, well, their role is to try and map out what they know of policies that has been out there. It's not what people are wishing for, because that can be everybody's wish and there can be a lot of different things. They have to try and make things quantifiable so they can calculate something and they can map out a pathway. So I think really the big shout out here is that investors, policymakers and so on, they should get much more clear about what is it that they want, instead of pointing fingers at somebody else and saying, hey, you are not giving us what it is that we want. I think that would be a great way, and that's where we try to fit in. We do financial analysis. We did one report here. All our reports are available on carbontracker.org. I hope I can do a little marketing. It's free, so it's not really marketing, and you get more money back on return on your generous funding. We did this year report together with the PRI and 5 European pension funds, really to look at upstream oil and gas companies. What are their future potential capex that is at risk of being stranded, as we talked about before. We look at close to 70 of the biggest companies. We even make a list I don't expect you to see it here, but you can find it online, of which companies have which portion of their future capex investments are going to be inside and outside of a 2-degree pathway. We used the IEA 450 scenario that has now been updated to SDS, I think it's called, a Sustainable Development Scenario. Basically, get to the same result. But this is at least one way of using industry data, and the other side of the equation here is the future capex investment. We are collaborating with a Norwegian oil service company, oil energy consultancy company, called Rystad Energy Group, which provides the data, the underlying data on which companies have which exposure. But using this, we can really go in and create an economic model for saying which companies are more at risk than others. And that can lead to some very interesting discussion with the companies. And we can come back and take the discussion on whether divestment versus engagement. I think it's always get a little sad, to be honest, when it's being put up against each other. I think they go very, very well hand in hand. Because if you have a big stick, it's so much easier to get something done when you're actually discussing with people. So that's probably more our approach. We're not advocating for divestment or engagement per se. I think we're probably saying that there's a lot of things that can be done. And given that we don't have all the oil and gas we already extracted today that we need in order to secure some kind of economic development going forward, then we still need some of these things. And whether you should divest from them and so on, that's a little bit different discussion. We can continue with that later on. They put on this in here in between us, but that's not
as well as literal.
So I think that's really the thing. I think we absolutely agree that the scenarios that has come out from the company so far is crap. But I see this as a lot as a tennis match. So shareholder resolutions last year, that's a serve, the aggressive serve, and then it's some kind of a weak return, I think it's called now. But now it's up to the investors to come back, because it is a bit the situation. That's also what we have done in this report. All companies are measured according to the same methodology. We are a very big advocate for a reference scenario. Would that be perfect? Absolutely not. That doesn't exist. But we get more to an apples-to-apples comparison. It's a little bit like the way it is right now. Now we are at Columbia. The business school, I think, they definitely will have more of a statistics 101 class. I'm not sure here at the law school, but the business school, the professor probably after hello, good morning, my name is Professor X. That will be how many in this class expect to get an above average grade. And that would probably be 95% saying, that's got to be me, because we all have our own view of how good we are. At the end of the year, of course, we have an idea about who is getting an above average grade. But right now, all the oil and gas companies, they are the 95% because they're all using their own scenarios. Like Exxon, for instance, come out in a big response to the shareholder resolutions last year, come out with a big response in 2018 where they're basically basing all their scenarios on 2010 results and technology costs, known technologies, and so on. That's ridiculous. Of course that's ridiculous, but that's also why it is up to the investors, to the politicians, to the industry people to say what is it you should, what are the guidelines you should lean up against. I have been, maybe just one last comment to tie in maybe to some of the next one is, I think engagement on a one-on-one basis, company by company, that doesn't really work that much. As said before, I've worked 20 years doing roadshows with company management, and they could, no problem when they're out selling a company, selling a capital increase, go to the first meeting at 8 o'clock, and then somebody asked them about climate, and they say, well, you're the first one who have asked us this question. And then they go to the next meeting at 9 o'clock, and then somebody asks about climate, and they will say to you without a hint, you're the first person who have asked us about this, and so on. But if you do collaborative engagement, where you all go together and then say, hey, now we're suddenly 25% of capital of the owners in the house, and we all sit here, then you cannot come out and say that you're the first one who have asked about this, because now we own a big part of the company. If you don't do as we say, we'll replace you.
I would love to have more time to discuss this. It seems to me a bit reckless of the IEA and others who know better than to put out the scenarios that they are putting out and to give us a 50% chance of staying under 2 degrees. First of all, my only other concern that we can talk about later if we have time for questions is to put it back in the court of investors who don't necessarily have the tools or background to know exactly what to ask for. So I'm interested from an academic perspective and others and from a carbon tracker perspective, how to give the tools, how to design, how to give the proper context to the investors to know exactly what they should be looking at and how they should be understanding these. But I want to leave time for questions, but I also really want to end on a more proactive note. So Ellen, what's a great compliment to your work on divestment has been your work on investment and on how to actually mobilize finance for the just transition. So I'd be interested to hear on that. And also, Jamie, I think 350's vision your mandate has expanded past divestment. So I'm interested to hear from both of you about investment and next steps, and then we can open it up to others.
So I know we're a little tight on time, and I'll try and be really brief. We've been committed from the very beginning that our work on divestment would also be coupled with a call to increase investments in the solutions in renewable energy and energy efficiency, energy access, decarbonization of all sectors, so the best in class in other sectors. And based upon IEA data, Ceres, the New York-based Boston-based organization, has called for a clean trillion in investments every year, that's what will be required to scale the solutions in time to keep us within 2 degrees Celsius warming. Their first recommendation is that every institutional investor needs to put 5% in the solutions. And just since they made that recommendation, new analysis has come out. ARENA just came out, the International Renewable Energy Agency, that said, look, it's more than that. We're going to need to move faster, quicker on scaling renewables, and that requires investment capital. So we're very committed to that call to scaling renewables. But again, I feel like you should know who you are as an investor. So we are not a big bank. We're a philanthropy, a not-for-profit institution, just like Columbia is, just like faith groups are. And so we look at what our unique role or our unique strength can be. We're currently working on a new initiative focused on the billion-plus people that don't have access to electricity today because they can't be reached easily or efficiently, cost-efficiently through fossil fuel grid infrastructure, and now we have the technology to leapfrog it. So I think a couple of cautions as we think about the energy transition and scale the solutions is that we can't leave anyone behind in that transition. So not only do we have to focus on the billion plus that don't have access today, criminal if they wouldn't have access with the new technology, and so investors need to help scale in the places, particularly sub-Saharan Africa, where the need is the greatest. Secondly, that we also focus on extractive community and extractive workers, that we can be using investment capital, loan funds to be helping to build enterprise in those communities. And then finally, I would say to the pension funds, and particularly, is that we need to start thinking about deploying capital more consciously in job creation. Maybe it's a 1% deployment of pension capital for job creation. Green banks, revolving green loan funds are a tremendous way to help create jobs, as well as address the solutions. And philanthropic institutions and other investors could come in alongside the pension funds, match that capital, and really look at how we can seed the solutions, create jobs, help distressed communities. And we better figure that out, because when automation really hits us, we're going to have a lot of displaced workers. And so we really need to be thinking about how to use capital differently.
What's next for 350?
Well, I'll go quickly as well. So, I think that, as we said, divestment is an incredibly powerful tool, but it's only one of many that we need to be applying, especially with the limited time frame that we have. I guess I'd extend Henrik's metaphor by saying if we're playing a tennis match, then the stadium is on fire as well. So we need to be sinking our last shot here, not just volleying back and forth as the whole thing burns down. There's more work to be done on divestment, for sure. As we said, New York State has an incredible responsibility and opportunity to really move forward with the mandate that Governor Cuomo set. So there's a advisory panel that will be advising the state pension system on how to do that. But I think as New Yorkers, there's a role to continue to make our voices heard, especially if people have pensions in the system, to use all the great arguments Ellen put forward to make that case that we need to see action. It is shareholder season, so it's going to be interesting to see what happens with some of these companies like ExxonMobil who have their shareholder meetings. Comptroller DiNapoli has been a big advocate for engagement. New York State has over $1 billion invested in ExxonMobil. This is a big spring. I think that if Exxon isn't delivering on really meaningful commitments, if it's just doing more of the same, this should be the last season that we go with the same requests that have been made decade after decade. Something needs to start changing, and New York has an incredible opportunity to really send a clear signal on that. Certainly here at Columbia, as I mentioned, more work to be done, and I think the students are doing great work on pushing for more transparency and action at this university, also at Barnard, also at NYU. There's great work going on across the area to really push that forward. Beyond divestment, there's all sorts of other fronts. I think that we're at a moment now with the crew that is down in D.C. where action really does need to be coming from the city and state and institutional level. So just I'll list a rapid fire, a few things that are moving and things to look for if you're looking to get more engaged. First is really tracking these climate lawsuits and liability fights that are out there. It's a really interesting new front. As Ellen said, just this last week, Boulder and others began to join it. New York City has sued these companies. That's something to keep an eye on for sure. The Exxon New and Shell New campaigns that are really digging into what these companies knew about global warming and what they then went on to lie about are incredibly important investigations, putting these companies on the spot. New York State's Attorney General, Eric Schneiderman, has been really leading that fight, and definitely as the public, it's our role to keep backing that up and continue to push that wherever we can. Finally, really continuing to help push this transition along as quickly as we can as the rest of the political system and financial system catches up with the reality that science is putting is a critical role for all of us. At 350, we have kind of two major focuses in that area. One is trying to stop new fossil fuel infrastructure from getting built that would lock us into emissions that we can't afford to have. There's definitely fights here in New York around pipelines and other pieces of infrastructure that simply cannot be built if you're serious about the scenarios that were put forward in the Paris Agreement. And second is really accelerating the transition to 100% renewable energy. It's great to see New York State with commitments around 50% by 2030, but 100% is where we need to go. There's going to be a rally, I think, in Albany this weekend even, on April 23rd, and buses are going from New York City to really push Governor Cuomo and others to up their commitments and push even farther on that. So continuing to really mobilize and support that 100% movement is something that we all can be doing as well. So I'll just end by saying it's an incredibly pivotal, interesting, dynamic, threatening moment that we are in. We've been blown away by the impact that this debate has had. I think it's gone faster, farther than even our most ambitious Google document plans for the divestment campaign ever put in terms of our goals. It's a sign that we can push harder, that we need to be pushing for faster action, and that we all have incredible power sitting in these institutions to really create transformative change. So I'm really glad to be here to have this debate, and hopefully this is the type of discussion that we can continue to be having as we move forward in this fight.
Great. Thank you so much. I know we're running very low on time, but let's try to get a couple comments together, and then we'll come back to so yeah. And I think that you should have, if you can push the microphone button. Sorry about that.
Can you hear me?
We can, yeah.
Thank you.
Better with the mic.
Thank you. Could you discuss some of the possible carbon pricing that can be put in place, and what litigation and divestment can do to help that implementation, if anything at all?
For the sake of time, great question. Let's just try to get a couple others, and then we'll come through the panel, and each can take the appropriate one. Maybe in the very back, please.
Yeah, I'll just talk loud. Great panel. Thanks for the comments. I'm just wondering, in the package of climate solutions you're considering to propose for for investment, are you beginning to consider investments in resiliency and adaptation to the ongoing impact that we're already seeing out there? And what are you doing in this whole transition to actually make sure that mitigation investments are actually resilient and climate intelligent? Because it doesn't seem to be very systematically factored in here. I don't know what magical technology is going to create all this negative emissions towards the end of the century, but it's going to be kind of unpleasant between now and then. So would love to hear your affirmative thoughts on that.
Great, thank you. Another great question. How about back there in the red sweater?
Oh, all right. Thank you. Thank you for thank you for all the suggestions along both the engagement and the disengagement, because having been an insider during the South African stuff within a company, I know that both actions can have an effect inside the company. So I appreciate your adding in this climate change issue, looking at how, in a sense, your efforts can often free up people in the company who want to take a more active role, both on the effects of the engagement and in the research that would be necessary for them to get into a role that is more constructive. Just P.S., Exxon had a whole solar energy research unit, small but very constructive, back in 1970, which I think dropped subsequently.
They come down a couple rows and. Okay. Great. Let's start up here, and then we'll take that comment, and then I think we'll bring it back to the panel. So.
Thank you.
And then we'll come in. Yeah.
Putting on a hat that I have not worn in about 15 years, I was the environmental advisor at the New York City Comptroller's Office, played a very significant role in making decisions about how those many hundreds of millions of dollars were invested, and had the fiduciary responsibilities, et cetera. And back then I said, this was after Exxon Valdez, I said, let's disinvest out of fossil fuels. And the response that I got, besides the general fiduciary responsibilities, which are very valid, was, well, if that's your recommendation, who are the financial experts we could consult with to get an alternative decarbonized strategy? And 15 years ago, frankly, I couldn't come up with anyone to speak to with that expertise. So how has the world of financial advising and investment changed since that time?
Great. Thank you. I think let's take this last comment up here, unfortunately, so we can bring it back.
I'd like to know what you think about publicly funded renewable energy. My concern is that if we have a completely privatized system that extracts profit all the time from a basic need that we have, what we're going to see is a replication of the healthcare system, which obviously is very expensive and doesn't work. So I'd like to know if there are such platforms through public bank funding, through bonds. How do you see that happening, and how could we support it?
Excellent questions, and I really regret how little time we have, but there's a second panel. I hope the panelists also will touch on these. We had excellent questions related to carbon pricing, to investment in adaptation and resilience, to the role of, and what's happened in the world of financial advisors, to publicly funded renewable energy. Could I suggest that starting with Michael, we come back and respond as briefly as possible to any of those that you would like to touch on?
So I'll just make a couple of comments. Investments in resilience, I agree, is absolutely essential. Unfortunately, most resilience kinds of efforts don't generate a return, and so they're much harder to finance than renewable energy, which sells electricity. There's a very important role for public entities here. The New York State Department of Environmental Conservation looks like it's about to modify the regulations under the State Environmental Quality Review Act to require consideration of climate impacts on projects, as well as the climate impacts of projects is part of the environmental review process. That's a very positive step. New York City has done a lot with building codes. I think there needs to be much more consideration of the resilience efforts in public infrastructure investments. The one other thing I would say on carbon pricing, of course, New York is a participant in the Regional Greenhouse Gas Initiative, which is a very limited, small effort at carbon pricing. The carbon prices are very low. Ultimately, we absolutely need a carbon price, probably through a carbon tax, to drive so much of what is necessary. There's discussion of doing it at the state level. You've got lots of leakage and other issues, but I think that discussion should go forward until we get to the point where we, some decade, have a rational federal government that can impose a national carbon tax, which is what we ultimately need.
Thank you. Henrik?
I think now it's green here. I think maybe just follow up on that. I think carbon taxing is actually an area that we are going to be focusing increasingly on. We're coming out with a research report next week about this, so I cannot say too much about it. But I think intuitively, you need a price on carbon in order to really drive anything. And you can see in other areas now we are not that Columbia Law School is encouraging that, but I think if you look in general taxation, one of innovation to avoid taxes, I think that's a very big driver for some of these creative structures around there. So you can say a carbon tax could drive innovation for how can companies make money on this. I think that's a good one to maybe keep in mind. A month ago, I was in Canada, in Vancouver. They have a big energy conference up there. Every state in Canada, they have, or province, I think they're called, they have different carbon pricing and so on. But they have CCS, which are startup working. It's still in a very, very small. But they only really get together because there's somebody who can get a carbon offset or price or something that has a value. And as Michael also said, yes, if you put up a wind turbine or solar panel, you create something like power that you can sell. But if you take out carbon, if that carbon is not priced, what is going to drive that innovation? I fail to see that, and I have not found anybody who can convince me otherwise. I think on the other areas, I think on the question about financial advisors, I like that a lot because that's kind of what we are doing. I think there's a lot of focus and an increasing number of organizations which are doing, I think, very thorough work also in the academia on what are the actual impact and who can you go and talk to. Sustainalytics, MSCI, etc. have organizations which are looking into this. So there's a lot of new people you can go and talk to and specialists in this area. And I think the last question about the public stuff, I think that's for next panel, for the green panel.
Thank you. Yeah.
Okay, random set of responses, maybe not as well integrated. In one of the questions, the fiduciary duty came up again, and I wanted to say something that I hadn't mentioned earlier that I think is just really fascinating, is that Jeremy Grantham, who's a world-renowned investor, recently spoke at an event that we were at the United Nations, and he said, look, I really wanted to look at this issue of if you get out of any sector, how would it affect the performance of your portfolio? He said, we went back and looked 30 years, and what we discovered is getting out of any sector, any one sector entirely, had negligible impact on your portfolio. He said, I was so shocked by the research and the results, thank you, the results of the research, that we went back and did it for 90 years, and we found the same result. So just a really interesting thing that I wanted to share. On the market for new products and new advisors, and is the market responding to these demands? Absolutely, it's explosive. I mean, in a lot of ways, I think the demand has grown so fast when you have $6 trillion in assets under management, making public commitments to divestment, and many other investors doing it without calling it divestment. Believe me, the market's going to respond. And one of the reasons why we created Divest, Invest, Philanthropy wasn't to pat ourselves on the back as foundations, but to get out front, get out fast, and start to create demand for new products. And the market has been responding really quickly. Public power, who owns the power, absolutely critical. There's some interesting models of public power emerging, renewable public power emerging, and we could talk afterwards about that. Also in the energy access space, we're working on community-owned systems, but I think there's another important question to be asked no matter who owns it. Renewable energy does not have standards. The industry does not have standards. And this is one of the few times that a whole new industry is emerging, and we could actually lay down human rights and environmental standards for a new industry, and we must. Don't think because it's renewable energy, it doesn't have environmental impacts. And already there are human rights impacts. Last point, which I don't have a good answer to, is the resilience and the adaptation. And what I will say, just because we're very involved in all sorts of aspects of the environmental world, is that even in one organization, you don't have good integration between those that are working on mitigation and those that are working on resilience and adaptation. I have this conversation every week with a very good friend of mine who works at WWF on the resilience and adaptation side, and he's like, we are not doing the analysis, and therefore we're really getting it wrong, that the mitigation projects aren't bringing in the resilience and the adaptation, let alone the investment piece. Although there are some investors that are working on resilience and adaptation, that the whole worlds aren't being integrated very well. So a big call to action, and it's an important one.
Yeah, and just I won't repeat all the good points that were made, but just a couple pieces here. In terms of the way that divestment and engagement can work together, I agree that they can, but we have to be real about how hard we're actually pushing these companies. As someone that's been sued by ExxonMobil and subpoenaed by Republicans in Congress, these guys play hardball. You know, we need to play hard back. You know, they're fighting like their businesses are on the line, which they are. We need to fight like half of the city is on the line because it's going to be underwater. You know, these are real fights with timelines attached to them, and we need to start getting real about what needs to be accomplished and what needs to happen in these companies over the next 10 to 20 years.
Science.
Yeah, and really put to the scientific timeline that supposedly all of our institutions and governments have committed to. Someone is lying, and we better hope that it's the fossil fuel industry and not the governments that signed the Paris Agreement. In terms of financial options, just Ellen spoke about the larger ones, but for individuals, if people are interested, the good news is that there are incredible opportunities now. If you go to fossil-free indexes, I think .org or .com, but if you Google that, they have a great list of index funds and other opportunities you can get involved in. There's great funds out there, Green Century and others, that can develop a whole portfolio for you. And even if you're sitting at Fidelity, there's easy ways to get in a BlackRock low carbon fund or whatever it would be. I think that these things have gone truly mainstream, and it's easier than ever to develop a portfolio that matches your social values and, as Ellen said, actually increases your returns, since all of these fossil-free funds have been outperforming the market as a large over the last 5 years. And the final piece on the public finance piece, despite all of being on this investment panel, I was a history major, not an economics major or environmental studies, and we have great examples to look for. When this country has faced enormous challenges in the past, World War II, the Great Depression, we've found ways to rise to the occasion, and it's come through public finance. It's come through massive government programs where people demanded that the country actually find a way to rise to the challenge. And those were ways that brought us together, that created new opportunities, new industries, new jobs. That's an agenda that, as we look towards elections that might be coming up, we need more politicians out there talking about what a Green New Deal would do for this country, what our generation's version of the moonshot would be, how we can create millions of jobs in these sectors, and make sure that they're good-paying jobs that support communities as opposed to jobs that actually take resources out of them. So that's an agenda that is attached to this piece of the puzzle. It's a political movement that is bubbling up in different places. New York is one of the places that could be leading that fight, and it's the fight of our lives, and it's going to take place over the next 2 to 3 years. So this is an incredibly important moment to really be pushing that work forward.
Excuse me, thank you so much, and what a inspirational note to end on. Please join me in thanking this really remarkable panel. And I think if you organize it, I think we might have a minute or two to stretch our legs as the next panel comes. Yes, so a minute or two to stretch legs, and then we'll please join us back for the second panel.
Hold on. Yes. Placement again.
You said you might want to. Yeah. Yeah, because look. Right? Trying to go. It's, you can't get through this. Go around the back. No, it's hard to get through these little spaces if you want to go behind the chairs and come around. And then I'll probably have you over here. Is that fun? So, really, okay. John was probably we'll probably to you guys. Did you have any other questions? Yes. Let's go with it. Smile. Good. Where do you over here. Yeah, over here. Do you want to sit by this? Yeah. Middle? You don't need a middle. Pecan here. Yes. Oh, wait. No, we should put Laura. And then Colin. Right? Because we need a female in the long line of men. We need a Philip, we're gonna have you sit on this side. You can go this side. Doesn't matter.
Yes. Well, I can stand here.
Is that okay? Yeah. I think it's gonna probably work better unless you want to do something again, but I think standing.
Okay. You're the boss.
Is that all right?
Whatever you say.
I wish more people would say that. I really do.
Okay. Well done. That was really, really good. Come and Dave. Good to see you.
Exciting times, Jake. Very nice to see you, Laura. I do. We were just with Ryan Deese actually in Boston last week. Awesome. Yeah.
there's high chair though. Let's get that.
You want to sit there on the end? Yeah.
I think we can pull this chair.
Yeah.
Okay.
So do you want to do that on this? How do you want to do
Well, you walk right here, then I'll...
Then you come back in.
Yeah,
Whatever you want to
absolutely.
do.
Yeah,
Okay,
let's do that. Yes, good idea.
I'm just going to remind you guys to make sure your phones are on airplane mode because it interferes with the microphones. And then it's pretty simple, just the middle button takes it off. When it's green, you're live. So when it's green,
So we're going to have everybody take their seats if you can. That really worked. Okay, everybody take your seats if you can. It'll be stronger next time. Well, hello again. When I spoke at the beginning of this in my opening remarks, the room was not anywhere near as full, so I won't promise I won't take that personally. But instead, will reintroduce myself and say, I'm Adam Zorroski. I'm the Deputy Secretary for Energy and Finance for the Governor here in New York State, and I am extraordinarily pleased to be here today with you and with these great panelists. And I think our first panel really justified and showed why this is such an important dialogue to have. I am also lucky enough to be working with the governor on our collaboration with the New York Common Fund, which is been a terrific working together to try to solve some of those issues for that fund that was discussed a little bit earlier, and so we're looking forward to continuing that work. But my primary purpose right now is to introduce my colleague and friend John Rhodes. John is, as I mentioned before, can really speak to some of the great, he's going to make a few remarks, but some of the great work that New York is doing under Governor Cuomo to try to address some of these challenges system-wide. We heard the questions come up in the first panel to emphasize why. John is the chair of the Public Service Commission. He's also the CEO of the Department of Public Service. He's the former president of NYSERDA, which is our New York State Energy Research and Development Authority. He is a tremendous thinker on these issues, a terrific colleague, and someone I'm pleased to work with on trying to tackle these important issues, and I look forward to his remarks. So, John?
Thank you, Adam, and thank you all for coming here and giving me a chance to share some of my thoughts with you today. So I have a couple of titles, but the real role is I'm a member of Governor Cuomo's energy team. And under Governor Cuomo, that means I'm a member of his nation-leading clean energy team to kind of green our energy system and to build a clean energy economy that really is nation-leading. And what we're doing is complementary to the topic that we're going to talk about. It contributes to it, and it depends on it. And what we're doing is, I think we're working in, let's call it the physical markets for energy. We are working to get investments made that are going to transform our energy system. Energy efficiency investments, renewable generation investments, storage investments, all the investments that we know we need in order to decarbonize the grid, and while we're at it, decarbonize the broader energy system, including thermal uses of energy and transportation vehicles. And we do that through policies, and we've got a lot of policy apparatus, and we do that with the utilities, and we do that with NYSERDA, and we do that by animating other actors, having them build their business around it. And at the end of the day, what we do is we get someone to make an investment decision to put something in the ground or in the ocean or in a building. It's either copper or it's steel or it's silicon, and it is a project that delivers energy in a way, in a solution that's better for the grid. It's more reliable, it's more cost effective, and it's better for the economy because it generates really good jobs, and it's better for the planet and the climate because it takes carbon out of the picture. So these are really good projects, but they aren't just apparatus out there. They are also really good financial assets, because what they are things, projects that generate returns for a long time, in a known way, in a predictable way, in a low-risk way, and that's a pretty appealing package. So we need a lot of those projects. We need their cost to come down. One of the good ways to get the cost to come down is to enlist more and better finance, because that's, you get capital-intensive projects and get better finance, costs come down. And to do that, we need investment dollars to come off the sidelines, and we need investment dollars in all colors. We need debt to come in, because a lot of these projects need debt, and we need equity to come in, because we need people to have stakes in the project and skin in the game. So our agenda is to get these projects built. To do that, we need good sources of finance that are oriented towards this clean. Now, I know there's a lot of this discussion, this debate, which is about the kinds of investments that we should not be making, that being the meaning of divestment. But whenever you talk about going from someplace, let's also recall that we need to be going to someplace. And what I'm here to remind everybody of is that we are building the asset class, if you will, that these investments can flow to. So don't be fearful that you're walking away from an investment and don't know where to go. Be confident that we actually have, and we're not alone, this is a booming asset class, we have places where that money can go to work. And while you're at it, you are driving our clean energy agenda in New York, which, as I said, is nation-leading. 50% by 30 renewables, a nation-leading clean energy efficiency goal announced today, nation-leading storage mandates, offshore wind, the whole panoply. So work with us, reorient the money, and put it to work on the clean energy agenda. So thank you for that. And then I have a second role here today. I'm also here to introduce David Sandalo. And, they tell you never to use cliches, but sometimes you have to go with it because it's so self-evident. David really needs no introduction. We all know who he is, and we all know his work, as we should. He really is one of our deepest thinkers on clean energy and our deepest influencers of thought. And he's also one of the great doers, and you can see that in the various roles that he's had in the federal government, State Department, the White House, State Department of Energy, at Brookings, here at the Center on Global Energy Policy, and and here at SIPA. He's also a prolific author of really useful, meaningful, change-inducing books, and it really gives me great pleasure to introduce him. He does have a weakness. I can report that sometimes he's been known to give away books for free, and I actually have a copy of Freedom from Oil back from 2008.
You didn't pay for it?
Not yet. Maybe I flubbed it, but I think we're lucky to have him working on our agenda, and certainly we're lucky to have him moderating this panel. Ladies and gentlemen, David Sandalo.
Thanks, John, for that very nice introduction. Thanks, Adam. Thanks to both of you for pulling together these great panels, and thanks for your leadership on clean energy, and thanks to the leadership of the state of New York and NYSERDA and the Sabin Center, Michael Gerard, and all you're doing on these issues. This is so important. Couldn't do it without leadership like yours and Michael's and others. I think we're at an inflection point on this issue. I think there's at least two reasons that we're at an inflection point. One of them is the Paris Agreement. The Paris Agreement isn't enough. It doesn't solve the problem. But I've worked a lot in diplomacy. I was in the State Department. I was on the National Security Council staff. I think it's important to underscore that at the Paris conference, 150 heads of state traveled to Paris for that meeting. It was the largest gathering of heads of state ever outside of New York. And heads of state don't do that without real reason. And also, heads of state don't travel someplace without giving a speech. And so 150 heads of state all gave speeches in Paris. And you can read through those speeches, and there was not a single one of those heads of state, not one, who questioned the reality of climate change or the need to take it on. And I think that demonstrates that the global consensus on this issue is overwhelming. It's extraordinary. And we have political forces mobilized all over the world to take it on. It's not easy. This is a tough issue. This is an issue that, let's remember, that is caused by invisible and odorless gases. So it is caused by invisible odorless gases that cause impacts that people can sometimes argue are caused by other things. So it's a really hard political issue, but I think we're at an inflection point globally in terms of the attention to it. And I also think we're at an inflection point in terms of the economics of it. I spend time in India these days working on renewable energy, and the Indian power minister last year said, in my country, solar is cheaper than coal. And the facts bear him out. It's really striking. If you look at the costs that the coal generators are selling coal power to utilities for in India, and we can see the cost of those long-term contracts, more than half of them today are more expensive than the most recent solar auction prices. So we're at a point where renewable energy is cheaper in many instances than the fossil alternative. My old boss, Al Gore, has a good line about this. He goes, I spent most of my life in politics. I've only been in business for about the last 10 or 15 years. And then he says, joking, I learned something. It turns out it really makes a difference when your product is cheaper than the alternative as opposed to more expensive. What do you know? And, with that profound business insight, I really think we're at an inflection point when it comes to this clean energy economy. And there's still more ways to go. I mean, I think people here are familiar with some of these statistics. 85% cost decline in solar in the past decade. 50% cost decline in wind power. Battery prices are coming down, not as fast, but they're coming down. We're just seeing tremendous progress. And so, as John was saying, what this panel is going to be about is the investing side of this issue. And where does the money go in the clean energy economy? How do we make sure the returns are available? And we couldn't have a better panel to discuss this topic. So let me just introduce them and then just get the conversation going. Starting at my right, at your left, we have Philip Rittman, who's a senior analyst and portfolio manager at Storebrand Asset Management. Gary Larbabera, who's the president of the Building and Construction Trades from the Council of Greater New York. We have, why don't I see, there we are, Laura Sagrafedo of BlackRock, who's with us, Colin Harris, vice president of New York Green Bank, and Jay Coe from the Leismith Group. And before we get started, I'm just going to make one more point. This may seem like a bit of a diversion, but I want to make it so. On the last panel, we heard a lot of discussion about 2 degrees and how we need to keep warming within 2 degrees and the 2-degree scenario. And that prompts me to wonder, just out of curiosity, how many people in this room grew up in the United States of America? I'll explain why. Okay. So for all of you people who did, that 2 degrees, it's actually 3.6 degrees Fahrenheit, right? So if you grew up in the United States of America, that's the way you think, right? For example, it was a cold morning this morning. It was 40 degrees outside, right? That's, for an American, somebody who grew up in the United States of America, that makes sense. For most people in the rest of the world, 40 degrees is a super hot summer day, right? So I actually think, just from a pure communication standpoint, we're kind of underselling this issue. When we warn people, oh my God, the world scientists warned that the temperature of the planet is going to increase by 2 degrees. Well, if you grew up in the United States, the way to think about that is the world temperature is going to increase by 3.6 degrees, the world average temperature. And I think it sounds a bit more scary. And by the way, if you add up all of the commitments under the Paris Agreement that have already been made, the consensus is that it will probably keep the world, that the world would warm about 3.2 degrees centigrade, which is almost 6 degrees Fahrenheit. So the Paris Agreement was a big step forward. But what it's done still is leave us with a world in which the scientists predict that we are likely to warm by 6 degrees Fahrenheit on an average basis. So we got a lot more work to do, which is why we need to bring capital into this game and what we're going to talk about here. So I'm going to start with my friend and former colleague, Jay Coe, who's done a lot of great thinking about this. And just ask you, Jay, to get us started. What kind of vehicles do you think investors should be looking at now in this space, and what opportunities do they have?
Well, it's great to be here. Hello. Oh, there we go. Hi. Thanks. Thanks, David. It's great to be here on this panel. Really appreciate the chance to give some perspectives from a couple different viewpoints as an investor, but also someone that's involved with part of the energy transition here in the state of New York, as well as on the global scene. So the three hats that I just need to describe very quickly are, I had the great fortune of serving on the board of the New York State Energy Research and Development Authority, and I've spent some time with John and others in this room working with that agency to help target that 50% renewable electricity target in the state of New York. The governor said, and we're moving very quickly towards across multiple wedges of the strategy. In addition to that, I sit on the advisory committee of the New York Green Bank, where a number of other folks that are in this room have contributed a lot of advice and perspective on it. And I'll leave Colin to talk about and brag maybe a little bit about how we've gotten to break even on that strategy a year ahead of plan and have done almost $500 million worth of investments, helping that transition along in a way that's good for New York ratepayers, New York taxpayers, and for the entire environment and the transition that we're on. In addition to that, I do provide some advice to the UN Green Climate Fund's board of directors as part of the private sector advisory group, so I have a little bit of a view of what's happening multilaterally as well. The point of view that I have really that I want to share with you today, though, is from the investment standpoint, and that is that the only way that capital is going to flow into this space at the scale required to meet the challenge, and the challenge is a combination of the mitigation challenge, i.e. reducing greenhouse gas emissions and slowing the trajectory that we're on, but also the adaptation and resilience piece of it, which I think is a little bit underinvested or under-focused on, is by getting that to a point where it makes rational risk-return sense. And that means for pension funds, it means for your 401k, it means for your insurance company so you get your benefits, it means for every single piece of capital that's out there so people can have dignified retirements. We actually can take care of the savings rates that everybody has out there. What's great is that we're now starting increasingly, as David has said, to reach a point where there's less and less intervention required by public entities and others to actually make that risk reward make sense. And that's absolutely clear, I think, at utility scale, increasingly in the renewable energy market. I think we're going to get there in energy storage and so on. So the kinds of vehicles that have grown up around that are no longer, idiosyncratic, alternative investment, private vehicle only activity, but also, as I think Laura and others will talk about, ways of doing this passively or your own investment portfolio for equity returns or for debt returns and so on. The other thing I think that's also possible is by reallocating some of the capital. Is this working? Just talk really loudly. Is that there's opportunities to reallocate some of this capital as well into focusing on the other side of the equation, which is the transition to a more resilient economy that's also low carbon. And that means looking at the adaptation question, looking at things that we can do in terms of tools, data, services, products, and solutions that will respond to the fact that the climate is already changing, that we need to be able to address that set of questions. It's the 5th anniversary of $20 billion of damage in New York City from Hurricane Sandy. $84 billion is required, according to the mayor's office in Houston, to restore Houston back to where it was before Harvey, and they have about 41 days before hurricane season starts again. And the real effects of the economic impact of climate change are already underway and will accelerate. So finding solutions to that, finding data, finding products that will do that, are really important possible ways to invest that I think are usually underappreciated out there. I think those will be increasing areas to invest. In addition to that, we should also recognize that everything we're doing that transition to the low carbon economy will help us out. If we are not reducing the scale of the problem, we're increasing the probability and the amount of impact of the next series of hurricanes on New York City and the rest of the country as well as the rest of the world. And so we ought to really think about the implications of the ongoing engineering we're doing with the planet. But there's plenty to invest in, and I think we'd be happy to talk about different strategies that are emerging in both the adaptation and resilience side of things as well as the mitigation landscape.
Great. Well, I think I'll start with the private investors here and then go, and so Laura, turn to you next. And I know you've been working in green bonds, and could you just tell us about that asset class and what you see happening there?
Yes, definitely. So I work at BlackRock, a large asset manager, but specifically I work on the fixed income side of BlackRock, which was traditionally the biggest part of the business, no longer, unfortunately. And part of our work there in our team is to sort of put some thinking around how we can identify risks that are related to climate change, both on the transition side, so the transition to a low carbon economy, and in terms of thinking about the manifestations of climate change when that happens, and we're starting to see some already, as you were mentioning, Jay, but obviously those effects will be more acute in the future. So we are starting to think about metrics and developing tools that we can sort of use to better understand how our investments can be better positioned for those risks. One of the instruments that have emerged in the green finance space in the past, I would say decade, but really the past 5 years where the market has become more vital, has been green bonds. I don't know if you are familiar with green bonds, but green bonds are essentially a bond just like any other, where the proceeds are earmarked for use on projects that have a positive environmental impact. These are bonds where the issuers commit to using those proceeds and they ring fence them in their balance sheet only for a specific set of projects that are deemed eligible. And again, it's not like there's a global standard around it, but there are some principles that have been codified by an industry-led initiative that's called the Green Bond Principles. And so there are about 4 characteristics that green bonds have to have. So we as investors, we look for those when an issuer comes to market with a bond that's labeled green. So number 1 is, as I was mentioning, use of proceeds. So the proceeds have to be used for these 9 or 10 eligible categories. And by the way, one of them is adaptation. The other 9 are mitigation related, but adaptation is certainly part of the picture here. Second, issuers need to identify a process for project selection and evaluation. Third, they need to have a process in place for the management of proceeds. So that, again, they need to be ring-fenced in their balance sheet with some kind of verification that is offered in that sense. And fourth, issuers need to commit to report on the use of proceeds. And on that sort of reporting requirement, the market has evolved more from reporting on, I issued a bond for $500 million, and I have used $300 million to build these projects, and I'm looking for a pipeline of $200 million to invest in the future, and this up to maturity of the bond. But that really has more evolved toward the concept of environmental impact reporting. So how do these investments actually contribute to solve this climate challenge? And I think that investors have really led that demand, and from our side, when we buy these bonds, we take a lot of issuer meetings, and we engage with issuers post-issuance, actually. So when we hold these bonds in these portfolios, we essentially talk to them. If we don't see this impact report coming out, we definitely push for that to happen. So what's really powerful about this instrument, I think, is that, as you were mentioning, Jay, traditionally, these kinds of investments in green energy, for example, were relegated to the realm of alternatives. And by definition, alternative means something that just looks a little bit fishy. And certainly, a lot of investors don't even have an allocation in their portfolio for alternatives. But the green bonds, really what they've done is they've pushed this kind of investment into the realm of fixed income. Just this is a regular fixed income instrument. So any investor, a pension fund, an insurance company, in fact insurance companies and pension funds have been among the largest buyers, and really they have pushed this market, and they have managed to increase its size quite rapidly. Just to give you an idea, 5 years ago, issuance was somewhere in the 20 to 30 billion and dollars a year, and last year we had about $160 billion in issuance. And the market right now stands at about $350 billion in outstanding debt. So this is a market that has grown really exponentially, and we expect that trajectory to continue into the future. But of course, that doesn't mean that in and of itself, this instrument will solve the incredible investment gap that we're facing if we really want to transition the world to a low carbon economy. Some estimates say that we are $1.5 trillion a year short, and certainly that will be a part of it. And I think that green bonds in the labeled universe can certainly do something towards bridging that gap, but it's not going to be enough. Obviously, we need more, but I think that this has been a tremendous success story, almost entirely private sector led. Really, investors have come together and they put these standards around what qualifies as a green bond, and we feel that this is like a really powerful example of what potentially can be applied to other asset classes.
Great, thank you. Phil, tell us, what is Storebrand Asset Management doing in this space?
Well, I think you alluded to something, which was, we need pretty much every tool in the toolbox. Last time I checked, I think we actually have the world's biggest green bonds fund. So it's absolutely a play that we agree with and that we see a potential market rise in as well. But I think what we have to understand is for institutional investors, what are the instruments that can start shifting some of this capital? And I think half the world's capital that are on stock exchange are actually pension capital. So how do you start moving that capital into a greener space and into a transition to a low-carbon economy? In order to do that, like I said, you need every tool in the toolbox. And I think the actively managed side is pretty easy to fix. Anybody can make a fund that's either low-carbon or fossil-free as long as it doesn't have too many holdings. The big question is how you start moving the passive allocation. How do you start moving that into a greener space? And how do you do that in a way that also doesn't give any risk to your clients? And that's basically what we've been focusing on, is trying to create these types of products that have a low tracking error, that are transparent in how they get to being fossil-free, and gives investors another tool to be able to move some of their passive allocation. And the passive allocation, and I guess the bond side in general, is probably going to be your two biggest asset classes that you would be holding as a large institutional investor. So it's important to start moving those sides as well. Like I said, the actively managed side will only represent maybe 4, 5, 6% of an institutional share or an institutional client's large holdings. So moving this passive allocated capital in the right direction is key if we want to be able to finance the transition to a low-carbon economy. Now, there's some interesting things you can do when you're doing that, as long as you can agree on, let's say, a tracking error budget that's okay. Now, what we've done is try to redefine tracking error a little bit with our clients and say, what if we could think about tracking error as a budget instead of risk? So if you can agree with your clients that you have tracking error of, let's say, 1%, and all that means is it'll deviate from the market roughly by 1% over time, is that okay for a large institutional client? If the answer to that is yes, then the next question is more interesting, and that's what can we fit into that tracking error budget? And what we've managed to do is fit in stuff like you can make it fossil-free, you could actually carbon optimize it once you've actually made it carbon or fossil-free, which actually does the trick of making that carbon data even more valuable than it is in the beginning, because carbon data is a little bit sketchy from the outset. Only 50% of it is real, 50% of it is modeled. So can you use that in an efficient fashion? Yes, if you use it correctly. So you can fit all of these things into a passive portfolio as long as you can agree the definition of a passive portfolio is, let's say, below 1%. And that's when you can start shifting serious amounts of capital.
Thank you. Gary, how do we do this in a way that makes sure that the transition works for working people? Any thoughts on that?
Yeah, thank you very much, and it's a pleasure to be here. So let me add a little bit more of a kind of a broader perspective to the conversation that I'm not certain many people often really focus on, and that is how do we transition the loss of jobs in the fossil fuel industry into the creation of a new industry and in clean energy. So I'd like to talk about that briefly, and I'd also like to mention that there's a reality when we talk about pension fund investment. We talk about, for example, the New York State Common Fund, which is a $207 billion fund. And then we talk about Taft-Hartley investment, private pension funds. So when we talk about Taft-Hartley investment, multi-employer funds, very common in the building and construction trades, collectively throughout the United States, it's well over $500 billion of pension fund money. And the question is, how do you entice Taft-Hartley or union pension funds in the private sector or building trade sector to invest into clean energy? Well, you cannot entice those funds and get those funds to be really interested unless there is a discussion about just transition in terms of employment. So when we talk about, becoming less dependent on coal or fossil fuels, one thing that you must remember and you must think about is that means the loss of jobs. And I like what was said earlier, that you come from something, but you, excuse me, you have to go to something. So coming from fossil fuels, you're now going into the clean energy space. But in doing that, you have to bring along the workers. And when we talk about solar, we talk about wind, just think, especially in urban environments such as New York City, someone has to actually install the solar panels, right? When you talk about wind off the coast of Long Island or New York City or into New Jersey, someone has to build the platform, someone has to erect the turbines. These are jobs. One of the things that has been really, I think, visionary by Governor Cuomo is that in this discussion, he has raised the issue of just transition. And he has taken some very strong positions that there must be labor standards and in many cases must be prevailing wages. So I think that's one piece of the puzzle that we need to focus on. I know it was mentioned briefly on the earlier panel. The other piece is, I think without that discussion being had, I don't know how you necessarily get some of the private pension funds, especially in the building and construction trades arena, to invest unless there was a just transition. And that includes training and the creation of new jobs. Because pension funds are obviously reliant on employment of their members. But beyond that, we can move and we should move to clean energy. But in doing so, we can't create low-road jobs. Because what we'll be doing is we'll be disenfranchising literally workers and communities. And so I think that's a broader discussion. And what I want to say is that a number of construction unions and transportation unions in New York State and New York City have really formed an organization that is I'm on the board of, which is Climate Jobs New York. And that is really something I want to say. I think that with Governor Cuomo's very bold vision and progressive vision, we're trying to be as visionary and as progressive. And I think our conversations that we've had and continue to have with the governor's office and with NYSERDA are going in a very positive direction. So what I want to end this comment on is that we must remember that clean energy and renewable energies are not, it's not a zero-sum game when we talk about or should talk about the creation of good-paying jobs with benefits and dignity for retirement.
And I think this is part of the resilience agenda.
Yes,
and we'll come back to this. But let me bring in Colin, Vice President at New York Green Bank. And could you tell us what is New York Green Bank's role here? What do you do, and what type of financing do you provide?
Yeah, absolutely. So first of all, let me say thank you to Columbia and to the Savings Center for having us here. It's a very wonderful panel to be a member of. I work at the New York Green Bank, and I'll give you an overview of the role we play, in addition to some of the successes that we've had in the recent past, as well as a brief outline of the business model itself, so that I hope you can all leave with an understanding of what we do at the Green Bank. So to start, the role that we play is as an investment manager. We're state-sponsored, billion-dollar investment manager with a focus on clean energy. The success that we've had has been recently measured by The number of proposals that we see in New York State, at this moment it stands somewhere between $2 to $2.5 billion. We've also invested nearing $500 million in roughly 3 years, which is a tremendous growth path to have been on, but also a demonstration of this business model as a means of success and a means for investment opportunity. We also, of course, are delivering public benefits to New York State, and one measure of those would be in terms of the greenhouse gas emissions that we've reduced. It's somewhere between 5.5 and 7 million metric tons at this time. We've also succeeded in, and thank you, Jay, for kind of teeing this up early. We're now what we call self-sufficient, which is to say that our revenues are greater than our costs. We're generating around well, cumulatively since our start, we've generated about $25 million, and we're net income positive. So this business model, appears to be working, and we're very pleased for that. As we go, the role that we're playing is to make investments with criteria that basically include a market return. So this is different from the rest of NYSERDA, which we're a division of. We are basically structuring investments such that there's a market return at the outset. There must be a greenhouse gas emission benefit to all of our investments. And lastly, which I hope I can speak to further a little later, is that we're transforming the financial markets in a way that allows for greater investment in this particular space.
Yeah, great, thank you. So I want to ask each of the panelists about opportunities that you're most excited about in this space. Kind of what do you think is most transformational, and what should the audience know about? And maybe this time just go right down in a row. Start with Jay, and then come this way. And then in a few minutes I want to throw it open to the crowd too, because I see a lot of expertise on this topic in the crowd. So.
That's great. From the private alternative investment standpoint, we think there's a tremendous increasing opportunity on the resilience and adaptation side of things, where retrofitting buildings to make sure they're going to withstand the new series of hurricanes or floods, making sure that the energy transition incorporates design that will be more extreme weather event resilient. We just saw a couple of nor'easters go through and impact the reliability of kind of grid power and so on. You're seeing Puerto Rico suffer through its situation now after an incredible amount of hurricane damage. So I think there's, in addition to making sure we're engaging in a low carbon transition, opportunities now that are going to start to increase as we get more visibility on these things to make a transition on the data side and then on the actual physical product side that includes the creation of good jobs or the enhancement of actual good jobs in transitioning to what will be a different environment where we will be more adapted to it. In conjunction with that, I think there's clear overlap in many cases with the clean energy transition, right? Distributed storage, distributed energy, microgrids, combined heat and power systems, all of these have additional benefits of being more resilient to these kinds of activities. In addition to that transition, I think we'll end up with a stronger, more efficient, more low-carbon economy here in the state of New York and hopefully nationally and globally that does include a transition that incorporates a real understanding of how we transition the entire economy, not just subsections of it. So I think it's a great opportunity for investors. I also think it's a great opportunity to make sure that we're making investments that also help us as citizens and members of the community. If we don't make this transition, we will accelerate the amount of impact that will suffer on lives and livelihoods.
And Jay, on the resilience piece of this, could you just elaborate on how those investments can generate financial returns? I mean, they're obviously hugely important. We need funding, for example, in Lower Manhattan for seawalls, but how does a seawall generate a financial return for a private investor, or are there other examples of resilience investments that do that?
Yeah, so it's the early days of this area, and I think most folks in the private sector, if asked the question of what is adaptation or what is resilience, will sort of throw up their hands, which is what we did a couple of years ago when starting to look at this problem and say, I don't know how that works or what happens. And I think in the early days, just as in the early days of the renewable energy transition or the low carbon transition, there was no such thing as the low carbon sector. We had to define how to get to that, and that became things like renewable energy, energy efficiency, climate smart agriculture, land use are going to be major thrusts to deal with this problem. We need to conceptualize this in a way that's appropriate. And so the kinds of opportunities we're seeing right now are very interesting existing companies and existing parts of industry that deal with the risks and impacts that we already have that will be increased by the climate change problem. Right? We have flooding, we have storms, we have water scarcity, we have energy issues, we have healthcare issues, which will be exacerbated by climate change. We're already seeing that happen. So let's find the companies that are best positioned and train the workforce for the future in that transition that are going to help us assess those risks as they start to manifest increasingly, and then help us to address those risks and prepare for them so that we're ready for these situations. Houston and a lot of Texas residents may not have been as, I think, forward-leaning, let's say, in accepting climate change from an anthropogenic sense several years ago, but after 3 years in a row of 1 in 100 precipitation events, one of which was a 1 in 300 year event, so I'm not sure if the 1 in 100 moniker makes any sense anymore, they're quite focused on building a more resilient and more recovered city that requires them to protect their communities, and that's going to be an entire sector of the economy. Up to $300 billion a year is the current estimate in developing countries alone by 2030 to deal with some of these impacts. And I think we're going to see increasing effects of this, and so I think that's an opportunity for investors to begin to prepare. And there's also a way of measuring some of the co-benefits we're generating. Green bonds have been issued in climate bonds context by the state of New York, by the city of New York's MTA, $200 million. There's parametric insurance structures, risk transfer strategies that are being developed. But I agree completely that this needs to be an all of the above strategy, just as it is in the low carbon transition. And also, those strategies, as was talked about before on the prior panel, need to be integrated with our low carbon strategy. If we do not design a low carbon strategy and transition to be resilient to the impact of climate change, we will have it be impacted by climate change. We saw several LEED-rated, energy-efficient building campuses in Houston that were literally underwater after the hurricane. And if we're not careful, we're going to build a lot of energy efficiency oriented structures or renewable energy that doesn't function the way it's supposed to because it's not designed for what will be an increasing transition. But there's a huge opportunity to invest there and a huge opportunity to reap the benefits on both sides of the equation that I think investors increasingly will have the opportunity to do and will create an interesting new, more protected economy.
Colin, what gets you most excited here, particularly in infrastructure, which I know you're financing?
Yeah, thank you. I would answer this question a little bit differently. I think the big opportunity right now is that, among all of us on this panel and many of you in the audience as well, we're creating the opportunities to direct large amounts of private capital into the clean energy economy. And by way of creating a new asset class or green bonds or investment criteria that work for large pools of investors, we will achieve the goals set out by the governor in New York State, but more broadly by the Paris Agreement, the U.S. Climate Alliance, and elsewhere. And that's the real opportunity that we all have before us today. I get very excited to talk about the underlying technologies, so I'll do that as well. The specific areas of opportunity that we in particular see happen to be around community distributed generation. It's an area in New York State that we're working very hard to provide a financial solution to. In addition to battery storage is an effort that NYSERDA and many other colleagues are working on, generally speaking. We also have, we've proposed an energy or a financial solution for energy efficiency and renewables as well. And of course, we have a general solicitation and RFP for clean energy finance in general. That's it. Yeah.
Great, Laura, same question to you, and then I'm curious also about the international aspect of the green bond movement, if that's something you're paying attention to. Is this just a U.S. movement, or is it happening all around the world?
Sure. Okay. So on the sort of geography of the market, no, it's definitely not a U.S. It's not a U.S. focus, and it's not a U.S. led market. In fact, this market was really started by the supranationals, so the multilateral development banks specifically, and the pipeline of projects that were funded through those issuances of green bonds, so the International Finance Corporation, the European Bank for Reconstruction and Development, the European Investment Bank, etc. Those pipelines were actually in emerging markets, which was a really interesting aspect of it, because obviously by aggregating those projects at a supranational level with a AAA credit, that funding was very inexpensive to build green infrastructure in places where typically that would be very costly if one had to rely on local funding. So no, definitely the market, let me just give you a snapshot. Currency-wise, it's about 40% US dollar and 40% euro. But that's just because there's a lot of issuers that seek funding across different markets. Definitely, we see sort of European countries leading in terms of both number of issuers and volumes. I would say that on the corporate side and financial side, we see definitely more movement on the European continent. Asia is just starting right now. And on the U.S. side, it just tends to be sort of other players. There's been a very, very large start with the bang of the securitized market last year in the U.S., that being sort of more of a U.S. type of asset, because Fannie Mae has securitized a bunch of loans that they make with sort of performance related to energy efficiency investments. And they've sold about $25 billion of that last year, so that was a really interesting development. And then you see countries like sovereign debt actually now coming to market with green bonds, with Poland being the first country in 2016, France being certainly the largest issuer. They've now tapped the green bond market for about $11 billion or so, and then a bunch of other countries, among which Nigeria, for example, and Fiji, and then Belgium just came out with it. Indonesia did the first sovereign green sukuk. So it's definitely, I mean, the diversity of the market is definitely increasing, and it's a global market. And what's interesting about it is that I think because this is a green instrument that can provide a certain amount or a certain degree of confidence to investors that what they are buying is actually going to fund green assets. And because of the impact reporting behind it, it's really, even the buyer pool is global. So that's what's really interesting about it. I think that traditionally in some of those some of these like sort of social instruments in the past, it used to be more of a local buyer that was interested in, let's say, like a bond from a sort of local community development bank or something like that. It was more sort of targeted to a local buyer. But what's really interesting in the green space is that as an investor who's interested in this and who thinks that there's actually some sort of risk mitigating factor in investing in green versus non-green, you really don't care where the mitigation happens because that has a global effect. That's what's really interesting about this market, and probably what has allowed it to grow so quickly, really, to the levels that we see today. In terms of opportunities, I certainly see, I think that something that really interesting that's happening is that we start seeing banks giving preferential loan rates to for example, developers of buildings that can prove that there's an energy efficiency component or a green building certification, et cetera. And potentially that in the future all those loans can be packaged and securitized. And so that would actually give a pricing advantage even to a bond buyer potentially. So you can actually get green and for less, which is really great. And by the way, when I talk about green bond pricing, generally speaking, these bonds price in line with their non-green counterparts. So that's something that's been really important to drive market growth, actually, because investors, even if they prefer a green asset, they still, when you're talking about a 1% sort of budget in terms of tracking error, we don't see that on our side. I mean, 100 basis points of loss return in the bond market would be a lot, and we don't see investors ready to do that. But what's really interesting about green bonds is that they have the exact same return as the non-green counterparts. The issuer risk is the same as non-green, right? Because it's the same issuers, but and in some cases, you have seen some green premium pricing, but basically that's completely insignificant, 1 or 2 basis points. So I think that really also has been essential in driving the market. But back to the opportunities, preferential loans, green loans, sort of you got better terms if you can prove that your building is green, for example. What's really, really interesting is that we see this now also reflected in credit rating, which I think is also a super interesting development. Just about maybe last month, a real estate investment trust came out with a green bond. It's called Prologis, out of San Francisco. Interesting that they issued in euro, actually, but it's an American company, and their portfolio is all green buildings. And Moody's updated their credit rating, and part of the update, and it's actually an increase in the credit rating of the company, was related to the green bond issuance, and I think we're going to see this more and more often in the future. And the reasoning behind it was that the green bond issuance, because the portfolio of buildings was going to get better in terms of energy efficiency, was going to attract better tenants at the building level, and so that was decreasing risks for the issuer. So we see that, I mean, hopefully that will happen on a larger scale, but we really see that as a total game changer in this market.
Thank you. Gary, you see any best practices or any great examples of how we make sure this money's invested in a way that creates jobs and promotes a just transition?
Yeah, so thank you for that question. And one of the things I would like to mention, too, just about opportunity before I answer that question. Mm-hmm. So I think that New York State has an opportunity here to lead the rest of the country. Right? And Governor Cuomo has, I think, already established that as a floor. And I think the model that we can develop here, which could be very attractive for investment, as well as really addressing the climate issues, could be a model that could be used across the country. And so that's one of the opportunities that I see that we have. I want to say this in many instances, as I mentioned before, you know, the fossil fuel industry is a very highly unionized industry, and it's a knee-jerk reaction, and it's a normal reaction that when we see that change in any industry is coming, that there's a level of resistance, and we see this creates a political paradigm that isn't always the most productive. But we do see this going on throughout the country. And I think that what we've done in New York with the unionized sector, along with the governor, and the discussion about just transitions is a model that we can move forward. I think that the other issue, to answer your question about the future and just transitions, I think that the opportunity that we're presented with the creation of literally a new industry, right? As was mentioned, there's a creation of a new industry. It is an opportunity where there is ripe for responsible investment, and it is ripe for creation of good paying jobs, union jobs, that provide benefits and retirement security. And I think that that's a responsible approach. One of the things that, you know, many of you should be aware of, we talked about the Common Fund. For example, the Common Fund was one of the first funds in the country, along with the New York City, 5 city pension funds, that have adopted a responsible contracting policy. Then the Common Fund, the New York State Common Fund, has the most aggressive responsible contracting policy anywhere in the country, and is, in fact, a national model that is being used. And, you know, we're talking to BlackRock, we're talking to Blackstone, we're talking to CIM, we're talking to other public pension funds across the country. And there are things that are happening very rapidly in terms of this responsible contractor policy, which is really a question, I think, to answer your question, is in terms of responsible investment and as it relates to just transition.
Thank you. And Phil, interested in what you think are exciting opportunities, and also it's a follow-up question, because you talked about a 100 basis point tracking error and how you think about that. And if I hear Laura correctly, she's saying, I think you're moving money on green bonds with a 1 or 2 basis point tracking error. So do you need 100 basis points in order to make this work, or not? So, any thoughts on that?
Well, I think what excites me is, you know, if I take a step back and listen to the panel, I think we've touched upon real estate, we've touched upon bonds, equity, private equity, infrastructure, renewable infrastructure, active, passive. And I mean, we need every tool out there. And I think what excites me is now that there's much more momentum around all of these asset classes. And we're going to need every single one of them if we're going to succeed. So that's exciting. I think I want to tie it a little bit back to the previous panel and also say, you know, divestment sometimes gets a bad rap. And that's fine. I think what the divestment side has missed a little bit in the communication has been divestment is also an opportunity for investment, right? So it's not just one of the, you know, they don't exist separately from one another. You free up capital and then you can invest it into something else. And I think, you know, engagement was also mentioned here, but if we talk about transition and jobs, and the reason why I think the Norwegian experience is a little bit relevant here is, you know, we're coming from an economy that's, what, 50% fossil fuels? Right, that's the entire country. So we also have this challenge of actually having then to shift the labor force, right? We have to activate and utilize the expertise that's within the fossil fuel sector and put it to use somewhere else going forward. And we don't have to do that to save the world, we have to do that to save our economy, right? And that's the key point here. And I think you're starting to see a transition from some major listed companies. And the question towards which engagement was raised of whether or not that's a little bit of a kind of fallacy and people hide behind engagement, I think that's absolutely true. But I do think there is some room for engagement towards companies that then have signaled that they want to do that transition, and there's a possibility to help them there. And I think that would also answer some of the jobs issue as well, is it has to be a more positive enforcing role where you get these companies to transition. You see the Danish oil and gas company, Dong Energy, even Statoil's committed 25% of the capex now towards new energy solutions. You're seeing more of this, so let's get more of it. And that's where I think there's an engagement possibility. And I mean, 350.org, talking a bit earlier, I mean, there's a huge amount of capital that's then submitted itself to wanting to divest. So what we could potentially do with that capital is exciting as well.
We are almost running out of time, but I want to see if anyone has comments or questions from the audience, and let's gather a few and then ask the panelists for some closing questions. So here, here, and here. Yes, ma'am.
So the private sector in New York State has done a lot to advance development of renewable energy technologies or infrastructure. So what is one federal policy that, in your opinion, is necessary to do the same thing?
A federal policy?
Yeah.
Great. All right.
Hello. Hello. Yeah. Well, I wonder, green bonds. Are you seeing that they have enabled the projects that wouldn't have been financed, or they allowed projects that would have been financed anyway with better PR?
Let's see. Right over here. And then last one, right behind you, sir.
Hi, this is a question perhaps pointed towards Colin. When you offered the statistic about 5.5 to 7 million metric tons of greenhouse gases avoided, a sort of vocabulary question. Some people a few years back were arguing that natural gas was going to be the transition thing. And when you say how many metric tons of greenhouse gas are avoided, is that in relation to substituting, let's say, natural gas for coal? In other words, I just want to check in. Your bank is not financing natural gas infrastructure like pipelines in New York State under the argument that it's saving greenhouse gases, right?
Correct. That was a yes or no, and I think we got a no, right? You're not, or you're not financing. You're not financing natural gas.
In natural gas pipelines.
Yeah. And right behind you. Yeah.
When you talk about investments, obviously some countries are better to invest than others, whereas global climate change is a global problem. So how do you then kind of attract investment dollars into probably countries that are not as competitive as America or Europe or somewhere else?
Great. Well, let's see. So Laura, there was this question about green bonds, and are they going into funds that projects that would have happened anyway? Or?
Yeah, So yeah, the question basically had to do with what people ask about additionality of the green bond market. So what that means is, are you diverting really dollars from brown to green, or are you basically just relabeling projects that would have already been built possibly with that as green? I don't think we necessarily have the answer to that. I think that it's a little bit of both, but I'll tell you why I'm not necessarily concerned about additionality. There's at least a couple reasons. Number one is that if a company thinks that it's actually a positive from an image perspective to issue a green bond, I say more power to them. I think that means that we've already managed to change the conversation. If you're a utility and you think that you can get possibly, some kind of return, non-financial return, let's say just PR return from issuing a green bond to finance your pipeline of renewable projects, I think it's a positive. And the other aspect of it that I think is not nearly, people don't give this market enough credit, is the fact that the very fact of issuing a green bond for a company is actually an opportunity to open up the investors base to investors that wouldn't have traditionally bought their debt. And I'll give you an example. So for example, an insurance client of ours that has a commitment and an allocation on green bonds, and we manage a really large portfolio for them. They bought bonds issued by, this was a utility in the Baltic states. And they told me that if it were not like a green labeled bond issuance, they never would have bought that debt, right? So then from an issuer perspective, the idea that you can broaden your base is actually really interesting. Now you can tap into all these investors that are mostly interested in responsible or socially responsible or sustainable or all of those things. And when issuers come to market, and typically green bonds are oversubscribed by 2, 3, sometimes 5, 7 times, depending. When they actually decide on allocation, a lot of them try to give preferential allocation to buyers that have dedicated, either funds or dedicated mandates for green bonds. So I think that that's really an incredible, actually, aspect of this market that isn't given enough credit at all.
Great. Well, let's see. We had 2 other questions. One of them is on federal policies. The other is on countries. And we have, let's see, 5 panelists in 4 minutes. So I think that's less than 60 seconds a person, but would anybody like to answer either one of those questions on federal policies or other countries, or just any closing comments that you'd like to offer? Jay.
I'll speak incredibly fast. But just quickly on the countries question, I think the fastest piece of that is just to drive the cost into oblivion, right? I mean, if the cheapest source of electricity in India becomes solar, and it will globally, then it will create an environment where these solutions will become the de facto solution and not just something we have to do because it's good for the planet and maybe we'll get our money back someday. So I think replicating that kind of cost curve across as many types of technology transitions as we can, improving them out, and helping to move the market into a position where they can understand that and generate the returns that can then be scaled. That's, I think, one of the ways that governments are doing that globally as well as in the United States. On the federal question, I'm going to dodge that by saying the reverse is true as well. Without relying on federal leadership, which I think we can have all kinds of conversations about right now, I think the example that we're setting here in New York State with regulatory policy, with NYSERDA's attempts to change parts of the market equation, with the availability and the expertise that's been built at the Green Bank, and the engagement on this discussion of what do we do with funding, how do we actually direct capital, can we do it in a transition that makes sense for folks. I think you can set standards that become national standards. And I think that's the leadership position that we have an opportunity for doing. The last piece I would say here is this. We've been talking about tracking error as like a negative return scenario. We've talked about discounts. I think the flip of this is actually true. Technology is out there. We've made solar cheaper than everything else in many places. And that's the solution that we should be going to, is an economy that's not almost as good as the economy we have, or almost as resilient, or almost as safe, or almost as good job creating. We should be shooting for an economy that's much, much better than that. And yes, the challenges are out there, and the environment's going to get more challenging and more different as time goes on. But that's the opportunity we have here in New York State, which is to take capital and not invest by looking in the rearview mirror, but invest by looking forward and setting targets that are resilient, targets that are low carbon, and helping to set a standard and a leadership position that the rest of the world can replicate. And if we can aim for that, and not just to be almost as good, but to be better, we have a much better chance of making the transition and building a society that we're going to be happy that our kids actually grow up in.
Jay, that is such a great note to end on, and as it turns out, we're out of time. So, thank you so much for a really tremendous panel. Please join me in giving me a big hand.